Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
Hi, this is Greg Friedman, and this is another episode of Peachtree Point of View, our podcast at Peachtree Group. And today I'm joined with two different individuals that are really good friends, but also they're super critical to our organization at Peachtree Group. One is my partner, Jatin Desai, who's our CFO, as well as Tim Witt. He's the president of our DST program, which is the program that focuses on aggregating 1031 money to acquire commercial real estate assets, as well as he's involved with all our programs that are focused on being tax efficient. Because the one thing we've always learned is tax efficiency is one of the cheapest ways to grow wealth. So you can really accelerate your wealth when you focus on different programs that allow you to be very tax efficient and help you to defer out paying taxes. And so today we're going to talk about bonus depreciation, because bonus depreciation has become really a talking point over the last several months with the new tax bill. And Tim, I'm going to start out with you because I know you're very familiar with that new tax bill. Can you sort of maybe just taking a step back, explain what is bonus depreciation and how it works and why why it really should matter to anyone that invests in commercial real estate?
Sure. And Greg, thanks for having me on today. And I should say from the beginning, I know we've done other podcasts on other tax advantage programs, 1031s, opportunity zones, Roth conversions. And I always say at the beginning that, before you make an investment in a tax advantage program, please consult with your tax advisor to make sure you can take advantage of those tax benefits. We're not providing, legal or tax advice on this podcast. And also I'd mention, never buy or invest in something just for the tax benefits alone. You want to make sure first it's a good investment, number one, and then it's great to have tax benefits on top of that. But looking at bonus depreciation, it allows a business owner, a real estate owner, to deduct 100% of qualifying assets in the very first year of ownership. And so it's a powerful tax tool that has not always been available. It started with the Tax Cuts and Jobs Act back in 2017. That's when bonus depreciation first became effective. And 100% level was good through 2023. And then per that law, it was going to step down 20 percentage points every year. And so for 2025, it was supposed to be down to 40%. Still interesting, but not as exciting as 100%. That's changed earlier this year. The one big, beautiful bill that was passed in Washington, D.C. now restores bonus depreciation to 100% going forward. I mean, it doesn't have that phase out. So once again, it's back to a very strong level. And why that's important is typically when you would buy an asset, whether for your business or buying investment real estate, you depreciate those assets over a very long period of time, depending on the nature of the asset. It could be some, personal property items have a shorter depreciation schedule, but typically commercial real estate, investment real estate is depreciated over a multi-decade period. Residential, that's 27 and a half years. For commercial, 39 years. So what that means is, let's say you bought property for $1 million. You cannot depreciate land, only improvements. So let's say the land is worth $100,000. Now you have $900,000 of improvements that you would depreciate over either 27 and a half years or 39 years. So you take that $900,000 divided by 27 and a half or 39, and that's the amount of depreciation you would get every year. It's okay, but it's not a huge amount when it's spread over such a long period of time. But instead, if you can take a big portion some portion that's all deductible 100% in the first year, there is a huge immediate benefit to that write-off.
So Tim, a couple of different comments. One is I love your comment about tax advice, and especially as it relates to using these programs, because the quickest way to not pay tax is to make a bad investment. So you should absolutely not invest in something just because of the tax efficiency side of it. I think that's a very great point to point out to everyone that's listening. But assuming you have a very viable investment, and Jatin, obviously we're partners, we buy a lot of assets together, we invest in a lot of different investments together. We like when we're having to pay a lot of taxes, because that means the investment's been successful. I mean, we've had a lot of success historically. So with that said, let's just unpack bonus depreciation as the two of us are looking to invest our capital. Maybe walk through something that we're working on Like where, we've talked about buying like a convenience store, buying the real estate of a convenience store that's being leased out to an operator. Like, why is that beneficial? How does, this 100% bonus depreciation work in that example? And let's also talk about how it relates to the development of hotel properties that we do as well.
Yeah, sure. So, obviously we've invested in a lot of different things together. Something we're looking at most recently has been kind of these convenience stores, right? So the IRS has got this special exemption for gas stations that allows for 100% depreciation on, actually they call it the 15-year life is the entire building itself as opposed to 39-year life. And so if you take that example that Tim gave, right, you can't depreciate land, but let's say you bought a gas station for $4 million, right? You got 75% financing, so you put $1 million of equity into it, right? Gas station sits on dirt that is worth $1 million, right? So you've got a building and you've got the contents inside the building, you've got the refrigerators, the racks and the fuel pumps and the actual building itself, the roof, the HVAC, all the various components. All that qualifies for 15-year life with the exception of the land. So the land's worth $1 million, we bought it for $4 million, we've got $3 million of depreciation that we can take in that first year. And so if you look at the capitalization, we put a loan for $3 million, we put $1 million of equity in, and now we've got $3 million of deduction effectively in our first year, right? So if you're at the 37% tax rate, which is, the kind of the highest federal rate, you're getting a little over $1 million back in tax savings. So we put $1 million into the deal, we own the asset, and we're getting about $1 million, a little over $1 million of tax savings in that first year. That's because the IRS has got that exemption for everything in the building being 15 years. For like the stuff we're doing on the real estate side, we're on like the hotel development side, for example, right? So you can't necessarily take that deal and get the same exemption because it was specific to gas stations in this case. For like a hotel development, if we're building something, we go in and we do a cost seg report. Once it's placed in service, that cost seg report goes in and says, okay, well, here's all the various components to that building. There's the actual physical structure, the steel and concrete. There's the carpet, wallpaper, plugs, all the various components that would be 5, 7, 10, 15-year components. And it puts it into this cost seg. And so what happens there is you now get, let's say it's a $100 million development. You've got land cost, you've got the various, hard costs that are in the deal that are not like short term, they'll be long term 39-year. And in the study, you can kind of take those numbers and get, roughly up to like a third of your investment back in what you can depreciate. So, it's super beneficial for that first year in the tax deduction.
So that's huge because as an investor, you're investing, assuming you're a real estate professional, because I believe you have to be a real estate professional technically to be able to take advantage of this. And Tim, I'll let you correct me, or Jatin, you can correct me if I'm wrong on that.
That's right.
But so if you're a real estate professional, using the example Jatin just gave, you're investing $1 million, in that example where you're buying a C-store for $4 million, assuming you have $4 million of income, you're effectively writing a check to buy, a hard asset being this C-store, which the C-store, in most cases is going to be leased to a third party. And you're probably buying it at a 6 cap or 6.5, 7 cap. So assume it's a 6 cap on a $4 million purchase price. You're collecting $240,000 a year of income. You're getting a loan of $3 million and you're paying hopefully, an interest rate, of something around 5.5, 6% on that $3 million loan. Assuming it's 6%, you're paying $180,000 a year of interest. So you're collecting $240,000. That's right. Paying $180,000 out. So you're netting $60,000 a year, assuming there's no principal repayment. Even if there is principal repayment, you're still creating value in that asset by paying down debt through the principal repayment. So effectively, you're making a positive return on your capital being invested that you would have paid to the IRS today. And this is not a forgiveness of tax, correct?
It's kind of a deferral of the tax, right? So you effectively get that depreciation. And so when you go to sell the asset, let's say you sold the asset for, you bought it for 4, you sold it for 5, right? And so you've got capital gains there. So that your basis is going to be effectively 0 because you've depreciated it, right? So you've got this recapture that happens when you sell it. Now, the interesting thing is like real estate, you're going to sell it based on some valuation of the cash flows, right? So you're not going to go in and say, okay, this pump is worth $1 and this is worth X dollars and this is what my purchase price is going to be. You're going to say, this gas station earns X dollars of income I'm going to pay some multiple of that to purchase it, right? And so when you go to sell it, there's a thing called 1245 gain and 1250 gain. And 1245 is like, how you recapture on like personal property. And 1250 is how you recapture on the actual non-personal property, like the physical asset. And so when you sell this, you're going to go in that 1250 bucket as much as you can, as long as there's no purchase price allocation between you and the seller, or the buyer rather. You're able to kind of convert that 37% that you saved when you bought it, right? You saved 37% on that depreciation, and the recapture rate on the 1250 is like 25%, which is the long-term, close to the long-term cap gains rate, as opposed to recapturing it ordinary. So you made some interest or, effective rate arbitrage on that.
And I know, Tim, I would imagine you would say that if you're doing this strategy with C-stores, and we'll use that as an example, and then we'll talk about hotels here in a minute. But if you're doing this with C-stores or car washes, if you structure this in a DST structure, it's very easy then to turn around, and if you sell the store 5 to 7, 10 years later, and you're facing potentially that recapture, you could easily, all the investors in that structure could technically go and 1031 into another investment in order to defer out the taxes even further. Am I wrong on that?
No, you're correct, and that's one of the powerful aspects of 1031 is that, and just if you don't know, just for people who are listening, if they don't know what 1031 exchange is, that's part of the tax code where you can sell investment property, take those proceeds and invest it into another investment property and defer all taxes. You defer cap gains and you defer recapture, which is really important in this case, especially in a case where you had a lot of bonus depreciation. So when you and Jatin go to sell that C-store in 5 years, you could do a 1031 exchange into another asset. It doesn't have to be another C-store. It can be any type of investment real estate and not have to pay any recapture tax. So combining the bonus depreciation with a 1031 exchange is a really, really powerful solution. It's also one of the benefits of investing in hard assets and real estate versus non-real estate. Let me give you an example. You could get bonus depreciation from buying. I could buy a sailboat for $1 million, and I put into a charter fleet down in the U.S. Virgin Islands. And I'm going to put 25% down. That's $250,000. I get to write off $1 million in the first year, and so I'm going to probably write off more than I put down. So now I have in my mind, hey, I got a free boat. All the expenses are paid, and I get to use it a couple times a year. Like, how would this get any better than that? Well, what happens in 5 years, right? In 5 years, I'm getting kicked out of the charter fleet because the boat's tired, and now I have all the expenses myself. But if I sell it, number one, I'm going to take a massive loss, and number two, I'm going to get killed with recapture tax. So you don't have that ability to do a 1031 on personal property. You can on real property. So a huge benefit in investing in real estate. You can have the bonus depreciation, and you can continue to defer that recapture tax. Super, super powerful solution.
Yeah. And that's a really good point to make as well, because as it relates to real estate, in most cases, real estate is appreciating, especially if you're picking the right locations. We're obviously in an environment where rates are substantially higher than what we've experienced over the last, decade pre-2022. So the expectations are rates are going to remain relatively the same or come down some. So when you look 5 to 10 years down the road, beyond just the rent bumps that you have with these leases, typically when you're doing a C-store or a car wash, you have a third-party operator that's leasing the store from you. So you have rent bumps. So if you're buying at a 6 cap, it's eventually going to grow to a 7 or an 8 cap, depending on the rent bump schedule, and you'll be able to get some premium when you sell it. So it makes it super powerful, super interesting, and you can also own it technically forever as well if you don't want to have that recapture. Or theoretically, you could own it forever. But just shifting to how it works within, like, for instance, hotels, and Jatin did mention this already, effectively, you may not be able to get 100% of the check that you would owe in tax, assuming you have enough income to offset it, but you would get about a third back because you don't have as much depreciation coming off the first year of a hotel. But that is still very beneficial if you can get back, call it 30 to 40% of your initial investment in a new development hotel property. And we've done this many times, Jatin, where we invest into a new development hotel property, and effectively we're getting back 30 to 40% of that money technically the first year that the property's in operations, where it gets that bonus depreciation. So, without, receiving actual distributions from the cash flows, which we do expect, to get distributions from cash flows and eventually sell the asset for, premium and get, great returns. That's our expectations when we make those investments in a development deal. And usually those deals underwrite to give much greater returns because they do carry a more risk than what buying a single tenant C store or whatever the case is that's leased to a third party, but you get much higher returns, but you also get 30 to 40% of your money back that year one, which is super powerful. So when you're writing that check, it's something to really think about, where you're allocating your capital to make sure you're not only investing into great projects, but you're getting the benefit of these tax efficiencies. So with that said, with the new, tax bill, and a lot of people talk about it, the big, beautiful tax bill. I mean, some people are talking about the bonus depreciation, but to me, this aspect of the tax bill really makes it beautiful, as people say, because it is so powerful, especially for real estate professionals and helping to defer out income where they don't have to pay tax today. Do you expect anything to change as it relates to bonus depreciation over the next couple of years, or is this a permanent program at this point?
Yeah, no, I think it's a permanent program. I mean, at least for the foreseeable future. I mean, when it comes to politics, it's hard to make any strong bets over a very long period of time. And there's other aspects of the bonus depreciation beyond what we've talked about. There's incentives for manufacturers. There's just a thought of wanting to bring more manufacturing back to to onshoring it back to the United States. So there's some major tax benefits, major bonus depreciation there. So there's a lot of areas that all kind of tie together. That create investment to invest in real estate, to upgrade real estate. Greg also want to mention, use the term real estate professional. I think we should talk about that very, very briefly. There's a definition that the IRS provides on who is a real estate professional. And in simple terms, you have to spend over 50% of your work on real estate and have to have a minimum of 750 hours a year on real estate. And that's like doing real estate work. Is that you can't be doom scrolling Zillow for 15 hours a week. That doesn't count. And so you kind of think about who can take advantage of bonus depreciation. I'd say there's kind of three categories of people. There's the people who are real estate professionals, and for them, they can deduct that bonus depreciation from both active income and passive income. But most powerful part is on their active income, especially if they're in a super high tax bracket. Next, you have people that are not real estate professionals, but they get passive income from other real estate investments. So that bonus depreciation could be very helpful to reduce their tax liability on other income producing investments. And then the third category is people who are just a W-2 employee that don't have any passive income. And to them, there's only benefit to that one investment that they're making. But means they're not going to be able to take advantage of all of those depreciation write-offs in that first year. So again, there's a definition for real estate professional. And if you claim to be that, you're probably increasing your chances of being audited. So it's not something to trifle with. You really want to make sure that you truly are. And again, talk to your own CPA to make sure you fit that definition. And if you do, that's fantastic. If you don't, don't cross the line and say you are when you're not.
No, that's great advice. You never want to do something that's going to create challenges with IRS at a later date. So I think that's great advice for everyone that's listening. Just to close it out, I guess, Jatin, a lot of people argue that bonus depreciation is merely just pulling forward tax benefits without creating lasting value. Supporters say it's the single most effective way to stimulate the real estate investment and job creation across the U.S. Where do you land on that debate?
Where do I land? I think that, people shouldn't do things because of taxes, right? Like you shouldn't go buy something and go overpay for it because of taxes. I think that what this allows for is it allows for people to get a benefit by investing generally, right? So development, putting new things in the ground, innovating assets, doing those various things that will improve real estate. I think it's great for the general economy and great for us. I think that the folks that say it's just delaying, or just, creating kind of a delay or deferral in taxes, that's true. But, as Tim just mentioned, you've got active and passive income, right? And it can offset your active income. So you get this tax rate arbitrage that's super meaningful. So even if it is just delaying your tax that you have to pay, you're still saving 37 to 25%. So you're saving 12% on your tax rate arbitrage, and you're getting that time period to go reinvest your dollars. So I don't see how it doesn't benefit anyone, even if you say that it's just a deferral. So I'm a super proponent of this, and I'm really glad they added it back to the tax bill.
Yeah, I totally agree with you. I think it's a huge incentive for people to invest into development projects. It's a huge incentive for people to acquire certain types of real estate that has a more powerful benefit of the 100% bonus depreciations, like C-stores and car washes that we talked about a bit. And that just provides more liquidity into real estate that gets recycled. And ultimately, as people have, as developers are able to get their capital out, developers like to go develop. That creates more jobs. Right. That creates more, lasting values in these communities, really, drives economic development in these different communities and so forth. So I think it's a super powerful tool. But I just want to say thank you to Jatin for you joining today, Tim, as well for joining, this episode of Peachtree Point of View. And, we're committed as a firm to continue to educate investors in and around the commercial real estate ecosystem about, different ways to invest capital. If it's investing through credit strategies, but through equity strategies, and finding different ways to utilize programs that are very tax efficient, like bonus depreciation, and being very thoughtful about how they're investing their capital. And if you ever have any questions about, bonus depreciation or how you could, benefit or potentially not benefit from bonus depreciation, absolutely feel free to reach out to myself, Tim Witt, Jatin Desai. The three of us are always happy to be a resource. And we really appreciate, everyone tuning in today. And we look forward to, y'all listening to future episodes of Peachtree Point of View. So thank you.
See you guys.
Thank you.
See ya.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.